A reporter once asked Bill Gates, "How did you become the richest man in the world?" Gates replied, "Good vision." That's actually a perfect answer. We all know small money comes from hard work, but big money comes from foresight. But what exactly is good vision? Most people still don't understand. Whether you're doing real business, financial investing, or just building your career understanding, this principle can change your life. In this video, I'll break it down in a simple way, so anyone can understand it. Once you grasp this idea, you too will have greater vision. Let's start with two real-life cases. Case 1. In 1993, Mr. Chen sold his courtyard house in Beijing for 500,000 renminbi, about $80,000 at that time, and moved to the United States to chase his dream. 20 years later, in 2013, after years of hard work, he had saved $1 million and decided to return to China for a comfortable life. But to his surprise, the same courtyard house he once sold was now valued at more than 100 million renminbi, roughly $15 million. That means the price had increased by over 200 times. No matter how hard he worked, he could never afford to buy it back. Many people believe that high returns always come with high risk. But think about it, if Mr. Chen had simply done nothing, just held on to his property for 20 years and earned more than 200 times his money, did he really take on any risk at all? Case 2. A Japanese investor put 10 million yen into the Nikkei 225 index in 1990 and sold in 2010. Another Japanese investor also invested 10 million yen in the Nikkei, but in 2010 and sold in 2020. One invested for 20 years, the other for 10. What was the difference? Let's pause here so you can think about it. The result? The investor who bought in 1990 ended up with 4,288,000 yen. But the investor who bought in 2010 ended up with 26,830,000 yen. Investing 10 fewer years, yet earning far more. Why did this happen? Once you finish the video, the answer will become clear. Now, let's take a quick look at the 5 major industrial shifts in human history, because understanding them will help you develop real macro judgment and foresight. In the 1760s, Britain launched the Industrial Revolution. It became the first factory of the world. But soon, Britain ran into a problem. It needed cheaper resources and bigger markets. So, starting around the 1840s, it began moving part of its industries abroad, mainly to the United States. That was the first wave of industrial transfer. As a result, America's industry grew rapidly and eventually surpassed Britain's. After World War II, the United States became the global superpower. To stop the spread of the Soviet Union and communism, America decided to rebuild its allies' economies. That triggered the second wave of industrial transfer. In the 1950s, the US shifted parts of its manufacturing to Japan and Germany. When the Korean War broke out, the demand for war materials skyrocketed, and Japan's economy took off like a rocket. Both Japan and Germany rose from the ashes and became new factories of the world. As Japan's economy reached its peak, it faced the same old problem: limited resources and a small domestic market. So, starting in the 1960s, Japan began moving its labor-intensive industries abroad. The first destinations were Hong Kong, Taiwan, Singapore, and South Korea, the so-called 4 Asian Tigers. That was the third industrial transfer. They took the baton, built strong manufacturing bases, and became the new centers of industrial power in Asia. But soon, the 4 Asian Tigers ran into the same challenge: rising land prices, higher labor costs, and limited room to grow. At the same time, China was opening up to the world. It had a massive labor force and a huge domestic market. global capital began flowing into China. Companies from the US, Japan, and Europe moved their production lines there. That marked the fourth industrial shift. China became the new factory of the world. Made in China spread across the globe. China was the biggest winner of this transformation. Meanwhile, Japan entered what became known as its lost 2 decades. By now, you might start to understand why the Japanese investor who put his money into the Nikkei ended up losing. By the end of this video, you'll see the logic behind it much more clearly. Let's keep going. But history always repeats itself. After 2012, the fifth wave of industrial transfer officially began. This time, the direction reversed from China to Southeast Asia, Mexico, the United States, and Europe. Why did this happen? The reason is simple. In the early reform years, China discouraged real estate speculation, so resources flowed into manufacturing. Factories thrived, and a generation of great entrepreneurs was born. But after 2003, real estate became the core industry. Speculating on property became far more profitable than running factories. Manufacturing struggled, and innovation slowed down. As housing prices pushed up land, labor, and living costs, China's manufacturing edge began to fade. Low-end industries started moving to Vietnam, Indonesia, Thailand, and Mexico. High-end industries, supported by robotics and 3D printing, began returning to the US, Japan, and Europe. This is the fifth industrial shift, a two-way flow, one end to Southeast Asia, the other back to developed countries. And China, for now, sits in the middle, being drained from both sides. According to historical patterns, this cycle may last 20 to 30 years. By studying history, you now have a basic understanding of how wealth flows. From history, we can see that every industrial migration brings a massive transfer of wealth. Those who recognize the pattern early and position themselves ahead of time can easily gain extraordinary returns. Next, let's discuss how to anticipate these changes, how to develop true foresight. In Chinese, there's a single character that perfectly captures what I mean. But in English, there isn't an exact equivalent. The closest word would be trend. And a trend is mainly shaped by three forces: capital, resources, and the population. By analyzing the interaction among these three elements, we can project where the next big shift and the next great opportunity will occur. In 2001, China's economy began to soar. That was the year it officially joined the World Trade Organization. At that time, China's GDP was about 95,933 billion yuan. 20 years later, by 2021, it had grown to about 1,149,237 billion yuan. Asset prices, especially in real estate, skyrocketed. After 2012, as manufacturing costs in China began to rise, the country's manufacturing sector started to gradually move abroad. High-end industries began returning to developed regions such as Europe, the United States, and Japan, while low-end industries shifted toward countries and regions like Southeast Asia and Mexico. The COVID-19 pandemic in 2020 further accelerated this trend. As capital and industries returned home, the stock markets of the United States, Europe, and Japan began to surge continuously. Countries like India, as direct beneficiaries of this fifth wave of industrial transfer, also saw their stock markets soar. Even Mexico's market performed well after the pandemic. This pattern lined up closely with the direction of global capital flows. From China's reform and opening up to the real estate boom, the country enjoyed the dividends of industrial transfer. It was a time when making money felt almost easy. So I won't elaborate on that. Instead, let's focus on how to identify the right time to exit. Let's look at two of China's top tycoons. During the real estate boom, both made enormous fortunes, but their endings were completely different. Li Ka-shing began to withdraw from China in 2013, while Xu Jiaying, the founder of Evergrande, stayed all in on real estate. By 2023, after the Evergrande collapse, countless unfinished housing projects triggered mass protests, and Xu, once China's richest man, was arrested. This clearly shows, even if you have the best team and the best industry data, without the ability to read microtrends, your success will be short-lived. That's what we mean by having vision. Now, let's analyze this through the three key lenses I mentioned earlier: capital, population, and resources. First, capital. Foreign direct investment in China started to fall sharply after 2022, which shows that global capital is leaving rapidly. If you only choose to exit now, it's already late, especially given China's foreign exchange controls, which make capital withdrawal increasingly difficult. Compare with Li Ka-shing, you'd be almost 10 years too late. Next, population. China's birth rate has been falling rapidly since 2017. That's another strong signal. Finally, resources. Since 2003, China had treated real estate as a pillar industry. From then on, national resources began to tilt heavily toward real estate. Because real estate was far more profitable, capital started flowing out of manufacturing and into property. As bubbles formed, housing prices, material costs, and labor expenses surged, making it increasingly difficult for factories to survive. That's when industrial and capital outflows began. If we look at the housing-to-income ratio, China's housing prices started becoming overvalued around 2010. Coincidentally, this was also when manufacturing began to feel severe pressure. So, from the perspective of capital, population, and resources, China's investment environment after 2010 should have turned conservative. By 2017, with the population cliff becoming visible, that was already a clear exit signal. The 2018 trade war confirmed it. If, by 2022, someone was still increasing investments in China, it shows they never understood trend analysis. Even if they made money by luck, they'd lose it eventually. Li Ka-shing's timely retreat fits perfectly with his principle: never chase the last penny. His long-term success as the richest Chinese investor came from vision, not luck. By the way, what I'm sharing here is a methodology. In practice, every analytical step requires solid data support. For example, to verify population decline, besides birth statistics, I also cross-check the number of elementary schools in China to ensure the accuracy of the trend. When people talk about the winners of this global industrial shift, most would probably mention Vietnam or India. But in fact, Japan has been one of the biggest beneficiaries. Compared with Vietnam or India, Japan has a far more complete manufacturing ecosystem and supply chain. It also holds strong advantages in technology and skilled labor, advantages that others simply can't match. After the pandemic, Western countries deeply realized the risks of broken supply chains. They urgently needed to rebuild their industrial systems. However, because countries like Vietnam still face limits in infrastructure, labor, and technology, they couldn't fill that gap quickly. That's when Japan's importance became clear. This means Japan stands to benefit even more from this fifth wave of global industrial relocation. As a result, both Japan's real estate and stock markets are likely to stay well supported. After the pandemic, Japan's market offered a rare bottom fishing opportunity. Even Warren Buffett saw it coming. Since 2020, he has steadily increased his investments in Japanese equities, and even said publicly that he might invest more. By the end of October 2025, the Nikkei 225 index hit a record high, around 52,400 points. If you look back at the chart, you'll notice that between 2009 and 2012, the Nikkei completed its bottoming phase, and that perfectly aligns with the period when China's manufacturing sector began to feel real pressure. Buffett entered in 2020. If you master my analytical approach, might your investment vision even surpass Buffett's? Surprised? As you can see, it turns out that having good vision can be that simple. Please pay close attention to what I am about to say. The teacher who created this analytical method has students who now work in national think tanks using his approach for strategic national analysis. I can tell you with confidence, even if you wanted to pay high tuition to learn this method, you probably couldn't find it anywhere, let alone for free. Now, let's analyze with concrete examples. First is rare earths and other critical metals, which I discussed in earlier videos. This is a classic case of industrial relocation, shifting away from China toward Europe and the United States. Like other major relocations, this one will last for many years, so it is worth deep study. If you watched my earlier videos and still didn't understand why I focus so heavily on this sector, you should understand now. Even though multiple negative factors have recently pushed the sector's stock prices down sharply, some companies in this field still delivered multifold gains this year. That is the power of a trend. So how do I decide that rising mining-related stocks reflect a long-term trend, while the recent price drops are only short-term negatives? First, understand that the mining opportunity is determined by the strategic confrontation between China and the Western countries. The U.S. confrontation is driven by China's challenge to the dollar's dominance. Washington will inevitably try to contain China comprehensively, while China seeks to demonstrate the superiority of its socialist model. Tension with Europe stems from the Russia-Ukraine war, where China has taken a firm pro-Russia stance. Whether it's US-China or China-Europe relations, these contradictions have now reached a stage where they cannot be solved through negotiation alone. When relations briefly ease, it is usually because deep, long-term trade ties bind the parties together in the short term. Europe and the United States cannot easily replace many Chinese products. When China restricts exports of critical items like rare earths and key metals, Western countries often have to relent temporarily. But in the long run, decoupling is unavoidable. The trend of industrial relocation in the mining sector is therefore highly certain. This is a matter of national security for the United States and Europe, and it goes beyond purely economic analysis. It is political and strategic. Now, let's analyze the recent negative factors. The biggest near-term negative is China's decision to delay export controls for 1 year, a major concession. But from the White House's public statements, we don't see equivalent concessions in return. That suggests there may be hidden terms, and only by knowing those hidden terms can we judge the situation. Consider 3 hypotheses. Hypothesis 1. The undisclosed content includes an agreement on the Taiwan Strait. In exchange, the U.S. tacitly allows China to reunify Taiwan by force. If that were true, the negative environment would persist until any Taiwan Strait conflict concludes. Afterwards, China and the West would break with each other completely, and the mining sector would surge. This scenario would align with the Trump first logic, so you could observe whether China is preparing for a Taiwan Strait contingency as a way to test this hypothesis. Hypothesis 2. China, under domestic economic pressure, makes concessions to the U.S. and needs to prop up the stock market to extract wealth from retail investors and address government debt. That would require the U.S. to reciprocate by lowering tariffs. But based on the current agreement, U.S. concessions appear insufficient for China to reach that goal. Hypothesis 3. The United States is heavily supporting development of its own rare earth industry. If the U.S. can build its full supply chain, China will lose an important strategic lever. China might therefore delay export controls to cool investment enthusiasm in the U.S. and slow down the establishment of a new U.S. rare earth industry. If this is the case, the negative impact would likely last only a few months at most. How can we anticipate which hypothesis is true? The answer is to look for a comparator commodity, and that comparator is soybeans. This year, China has large soybean demand due to severe domestic crop losses, and soybeans are politically important for Trump's voter base. If China significantly increases soybean purchases from the United States, then the first two hypotheses become more likely and the mining sector's adjustment period could be long. If, instead, China shows no sign of buying US soybeans and instead steps up purchases from Brazil, that suggests the talks produce no substantive deal and the negative tide will likely end soon. Regardless, relative to the long-term benefits driven by industrial relocation, any of these causes would only be temporary negatives. We have not yet factored in the strong supportive measures the US government will put in place for the mining sector. Regardless of whether China relaxes controls, the US will certainly roll out many favorable policies to support domestic companies and break dependence on China. For investors, once you have identified the trend, you can pursue lower risk, higher return, long-term strategies. Most people trade short-term because they cannot see the trend. They end up chasing candlesticks and news, buying and selling frequently. Next, let's look at power and electricity. This is another shift I have covered before, not a geographic relocation, but an industry shift from oil to electricity. I won't repeat the full details here. Please refer to my earlier material. One extra point. If you master this way of thinking, finding good investment opportunities becomes far easier. For example, if you know electricity demand will surge, the inevitable result is an upgrade of transmission networks. Wouldn't that suggest metals like copper could rally significantly? Finally, one more example. Cathie Wood, often called the female Buffett, sold Nvidia shares last year, and SoftBank has also reduced its Nvidia holdings. Is Nvidia still worth investing in? In fact, we don't need to dive into complicated data to make a rough judgment. Ask three simple questions. First, is massive capital still flowing into the AI sector? Second, are governments worldwide issuing policies similar to the US CHIPS and Science Act to allocate resources to AI? Third, are the number of people using AI tools increasing or decreasing? If the answer to all three is yes, then consider this final point. As the leader in the field, if a company's products are in overwhelming demand and supply cannot keep up, is that company worth owning? Follow me, and let time validate whose foresight is more accurate, the big names or me. Today's content may sound simple, but truly mastering it still requires a lot of research and time. If you are interested, feel free to follow my channel. I'll continue bringing you professional analysis that will help sharpen your analytical skills. Thanks for watching, and I'll see you in the next episode.